Good morning, everybody. Welcome to today's 1 Million by 1 Million Strategy Roundtable for Entrepreneurs. 1M1M, as you know, is the first and only global virtual accelerator in the world. Our mission is to help 1 million entrepreneurs reach $1 million and beyond in annual revenue, build $1 trillion in global GDP, and 10 million jobs. Now, in support of that mission, we've been doing a lot of different things. One of those things is this series of free online mentoring roundtables, and this is our 272nd session of this format. So it's been going on for a long time, and you will find recordings of every single session on our YouTube channel. If you are live tweeting the show today, please use hashtag 1M1M. And if you are following us or would like to follow us on Twitter, please either use the handle at 1M by 1M or follow the handle at Stromana. Either of those would work. We publish a lot of very interesting content through these channels. And the recordings of these roundtables as well as other content are on 1M1M roundtables over at YouTube. Again, a very, very rich channel, which if you are missing sessions, you can always catch up there. These are the call-in instructions. We're not quite ready for call-in yet. We're going to have a conversation first with our special guest, Tom Foremski. But please start filing away your questions in your mind, or you can even start typing your questions in public chat. And if you want to actually call in and ask questions, I will put up the slide when we are ready for you to call in, and you can ask questions. But we, by all means, ask questions. This is a roundtable. We think of this as a working session. So we do want you to participate. We do want you to ask your questions, raise your issues so that we do want you to participate. We do want you to ask your questions. Okay, well, let me welcome Tom Foremski. Tom is a veteran journalist and publisher of SiliconValleyWatcher.com. Many of you, I'm sure, have read his writings for many, many years. I certainly have been following his work for a long time, and I know Tom is absolutely passionate about the subject that we're going to talk about today, which is the future of journalism. Tom, welcome. I'm so glad that you could make it.
Great. It's wonderful to be here.
So, Tom, I'm going to start us out with a few questions, but definitely feel free to, take us in directions that you are passionate about as well. So first and foremost, I think to, set the context of the conversation, you are a veteran journalist. Give us an overview of what, in your observation, what journalism was and what it has become today.
Well, journalism hasn't changed. It's just the amount of journalism has changed. Journalism in the new media world still has the same principles and the same structure and the same intent as it has in the old media world. The problem is that the business model for supporting that journalism is changing, and it's changing very rapidly. It's actually changing more rapidly for the new media companies than it is for the old media companies, because paradoxically, the old media companies still have print, cushion the blow of the change. And we've been transitioning from a print-based business model for the last 10 years, and that transition still hasn't completed itself. But for some of the new media companies who began with digital, they were digital first, the move towards mobile media is really challenging for them. And it's a challenge that not all of them will be able to meet.
So if you extrapolate from where we are, where is this going to end up?
Well, when I left the Financial Times 10 years ago, I thought within 5 years we'll probably find a new business model and everything will be back to normal. We'll have a thriving independent media industry. That didn't happen after 5 years, and I was thinking maybe it just needs a few more years. It still hasn't happened. And this is just really a continuing race to the bottom now. And the two business models that have shown some effectiveness, advertising and paywalls, are fundamentally flawed, and there's no way that they can support thriving media industry. You've got to get BuzzFeed-type numbers, which is in the 100 million unique views a month or so, in order to play in that field. And that can't support, for example, a local news outfit or many others.
So we are on the subject of business models. I've been observing this as long as you have been as well, and if granted from a very different viewpoint, but the ones that seem to me as viable businesses today are Wall Street Journal, The Economist, maybe CNN, and Wall Street Journal and The Economist are both very heavy-duty subscription models, right? They have solid subscription businesses. What are your, what are your thoughts about that pure subscription business model?
Well, it can support small publications like those, but it can't. It's not a business model that's available to anybody else really outside those. The financial news industry is quite a rich industry. It can support those kinds of publications, but we don't have a common media business model that, say, a local newspaper could use or a local news organization. And the problem with paywalls too is that why would you cut yourself off from the best feature of the internet itself, the amazing distribution of your content? I don't know if you remember the blue dress story from a few months ago. Was it blue? Was it yellow? It went ballistic, viral, and I kind of tongue-in-cheek said that this proves Foremski's first law of media, that content is near infinitely scalable. With one story, I could potentially imprint the entire internet, and it would be carried to the far reaches of the internet by other people's servers and networking equipment. For me as a tech company to have that kind of clout, I would have to build a gazillion data farms and so on. So content is amazingly scalable. Why would you build a paywall to cut yourself off from this fantastic feature of the internet?
So you're saying that even though the Wall Street Journal and The Economist are viable businesses in the financial news or business news sector, Economist a bit broader than that, but you're saying that the limiting of that content is negative because it's not really taking advantage of the distribution. But the other side of the coin is that lack of viability of other business models, as you were pointing out earlier, that mobile has completely killed the advertising business model, and there is no other business model. So how the hell do you support the company?
Well, I think it's going to come about in an interesting way. It's going to come through corporate media, through this native advertising, if you will, which I hate, because I think native advertising, for example, in the New York Times, just reduces the trust you have in that publication. And in fact, there's been surveys that have shown that readers reading native advertising think less of the publication that it's in, but they think more of the brand that it's advertising. So here we have brands that are deliberately poisoning the well. They're reducing the trust in, say, the New York Times by publishing native advertising, and yet their advertising has to run in publications like that. So they're shooting themselves in the foot. But the New York Times, in my view, by running that kind of native advertising, is shooting itself in the foot and in the brain. But
the New York Times in particular is becoming unviable. I mean, they're doing that. They're shooting themselves in the foot because they're having real trouble surviving, right?
Yes, yes. But then readers are going to be thinking, well, everything is corrupt, really. Everything they read in the New York Times or anywhere. In fact, that's generally the way people are looking at media these days, because the media industry is struggling. It's trying to make a penny here, a buck there. However, native advertising shouldn't be the way. It hasn't helped the New York Times. It's still losing money, for example. But, however, since people think everything is corrupt anyway in the media industry, well, start off with a corrupt magazine. Everything's paid for in this magazine, if you will. But supposing that magazine can then, from the profits of the paid-for content, hire a small newsroom and have independent journalists writing independently produced news that isn't paid for. And I think through corporate media, we'll be able to restart an independent media industry. Because corporate media has many advantages. For one, it doesn't have to rely on advertising. You know, corporate media makes something.
Is the advertising. Corporate media is the advertising. So Tom, let me pause for a second and explain to the audience a bit of this complexity. I'm not sure if everybody is on the same page with you and me on this corporate media and native advertising thing. So, so what's happening out there is that, you know, the newspapers and the, well, on digital media properties can't sustain themselves with advertising because mobile advertising rates are shitty, and that's where the maximum traffic is nowadays. And then there are no subscription business models because people want everything for free. The internet has become a gigantic free rider problem. Nobody wants to pay for anything. So against that backdrop, sorry, go ahead.
Important thing that nobody wants to pay for any media, any journalism, say. However, special interest groups will gladly pay for the media they want you to read, right? We won't pay $1.50 for the New York Times or whatever, but special interest groups will gladly pay for that media for us to read it. So
journalism is becoming skewed and biased.
Yeah. And with native advertising, these are articles that look like they've been written by independent journalists, but they're not. They're actually paid for by the company. So there's a little marker saying paid for by Dell, for example. Well, supposing Dell gets a really great story in the New York Times, does it have a little marker that says not paid for by Dell? You know, everything starts looking corrupt. And so when we have less trusted sources of information in society, we're going to run into problems. We've got important decisions to make about a lot of subjects: energy, the environment, the economy, education, elder health care, and those are just the things that begin with the letter E. Special interest groups are going to take advantage of this, and in some ways they are. In many ways that we aren't seeing because of the demise of the fourth estate. This is the media. This is what watches society, makes sure the rich and the powerful aren't taking too much advantage of everybody else.
Right, and the rich and the powerful can actually finance this native advertising trend and do all kinds of propaganda on whatever subject, whatever special interest that they want to support.
Yeah. I wonder how native advertising is going to work in the upcoming elections, because we'll say one party be creating a native advertising that looks like it's being written by independent political journalists, or will the New York Times allow that? The contradictions for native advertising just don't make sense, and it's not going to end up well. The brands lose out, and also the media brand itself loses out. Now, I don't think.
And yes, the media brands have no other source of survival. I think that's what's creating this kind of apocalyptic situation, is that what is the future of the New York Times? If you were running New York Times, what are you going to do? How are you going to make New York Times survive?
Right.
Right?
You don't do it through native advertising. You don't do it through a process that reduces trust in your brand. I mean, that is that is ridiculous. And the management does not understand the environment of its industry. It doesn't even understand the value of trust in a publication, and that trust is built very slowly over time. I mean, the New York Times, I think it's well over 30, 40 years old. Financial Times is about 125 years old. It takes a long time to build that trust.
Yes.
So why would you play with it? Why would you risk losing that trust with a reader? It doesn't make any sense. The New York Times is selling its future for a handful of beans. And in this story, there's no golden goose. There's just more pain in the newsroom. And
yeah.
you know, it boggles my mind that their management is so blind and stupid to this.
So what do you make of the implosion of GigaOM? That is a brand that had accumulated a lot of trust and was doing a lot of good work, but basically completely poofed. Yeah,
and that was a surprise because I think just a year previously they had raised another round. They seem to be doing well on the research side. They were having to do conferences and so on, like every other new media company does. But yeah, and then it just went poof. And you know, clearly there was something else going on there, I think, that we don't know about. But it was kind of interesting because one of their reporters, Matthew Ingram, writes about media quite a lot. It is
yeah.
always very pro-digital and so on and so on, and making fun of New York Times and paper, and yet, you know, they pulled the rug out from under him in just seconds. He was working on a story, got a phone call, boom, we're done. And the thing is I've always said that the disruption doesn't stop at the new media companies. They're still in the pathway of the ongoing disruption in the media industry. And the transformation to mobile is happening faster for them than
yeah.
the transition from paper to digital.
So, you know, my 2 cents on GigaOM is that it raised too much money. It raised like $50 million almost, I think, when, you know, all was said and done in the 10 years that it's been in existence. And if you contrast that with the TechCrunch, for instance, TechCrunch was built with very little money. It was like maybe, at the most, it was $500,000, probably less than that, Michael Arrington and Kip Thayer put in. And they built it to significant revenue, sold it to AOL. That, from a venture point of view, is actually a success story. Now, if you put $50 million into a company, then you have to generate return on investment, generate revenue at a level, generate valuation at a level that is way, way higher. And given that the fact that the business models of the industry don't really work, it's kind of an unworkable situation. That's why I think GigaOM went out of business.
Well, I think that's part of it, but part of it is the business economics of the industry, which continues
That's what
to
I'm saying. It's the business economics of the industry that don't work, and at some point investors wake up to that, and it's like, well, you know, this company is just burning money, and we can't really make it work.
Sure, but it's strange that it happened so quickly after raising a round of the investors clearly had seen the books and so on and seen whatever momentum was going on there. And this also brings about the conversation about, well, long-form content and quality journalism, that's what's needed. And Google has said that, and search bot, you know, rewards quality. But really, does it? Not really. A click is still a click is a click, and one of the biggest disappointments of the internet is that all these computer scientists and experts and so on over at Google and everywhere haven't yet figured out a way to recover the value of a great piece of content. You know, that's taken. We don't have a mechanism of recovering that. A click is a click is a click. And
yeah,
so any web page.
That's right. You know, one of my favorite, actually, one of the companies that I think is doing very nice work on long-form content is The Atlantic. And I actually don't know what their financials are or how they're doing in terms of monetization and whether they're going to survive or not, or are they facing the same kind of survival and existential challenges as everybody else. But they certainly do nice work in terms of long-form content, deep journalism.
Sure, yeah. And the thing is that the revenue, you have to run to stand still for these companies. And, you know, I saw the writing on the wall many years ago after I left the Financial Times. There's no way that the old world can really jump this chasm into this new world. Economics just don't stack up. And really it's going to, and I realize it's going to continue. The valuation of advertising is still continuing. The dirty little secret of Google is that it's not very good at advertising, but it does a huge amount of it, so some of it gets through. But for anybody else in that volume, it's impossible to compete with Google. And Google is a media company. I've said this for the last decade. Now people understand that better. But Google, Facebook, and Twitter, they publish pages of content with advertising around it. What's not a media company about that? Yeah, they use a lot of tech to do that, but you can't buy a piece of tech from any of these companies. You can buy a chip from Intel, you can buy a database from Oracle. Okay, you can buy a search appliance from Google. That's well, you know, I suppose a Google Chromebook, but it's not. These are media companies. And the web is a two-way internet. Internet 1.0, we could publish to anything with a computer screen. Didn't matter if it was a mainframe or if the computer was in your pocket. Internet 2.0 is that every screen now can publish back. Back comments, publish back video like we do. So it's a two-way internet. So this is what makes all the social happen. People used to ask me, what's the next big thing? And I said, well, it's blogging. He said, what? What do you mean? What somebody had for lunch that day? Is that it? I said, no, it's a platform. It's a two-way platform. This is now, we're off to the races.
So, Tom, are you following the experiments at Forbes? I used to work with Forbes, so I kept the cursory eye on Forbes. What do you think of what they're doing?
I think that they value the brand something astonishingly, but the whole goal was to be able to package up the company and then sell it, I think, to that Asian media group. I'm not quite sure what exactly happened, but they sold it for a pretty penny. Now, you know, Forbes still has a legacy reputation. However, it's difficult to tell who's the free writers and who's the staff writers. Well, you can actually tell because of the quality of content, but I feel that Forbes just really sold their own brand down the river and greatly devalued it. A little bit
so
like
how do you view user-generated content? Of course, Huffington Post is the biggest success story in that field. Huffington Post built this huge traffic base based on user-generated content, and frankly, some of the user-generated content is very good. Some of it is crap.
Sure. Yeah. But, we're the ones that we have to, sort the good from the crap when editors and newspapers, used to do that for us. We now have to do that ourselves. And so we're getting better at doing that. The great thing is that people are very media savvy these days. They know what clickbait is and so on. And they really get angry with people. And I think, and again, corporate media doesn't have to have clickbait. It doesn't have to put people in bikinis to get traffic. Corporate media really doesn't even want to publish something that's not true or spin or anything. It actually wants the conversation about the industry it's in, the products that it's producing. It wants to take part in that. So, and again, so this is why I think that corporate media potentially could even produce better quality media than the mainstream media right now, because it's struggling so much for the traffic that it's trying to stand up half-baked stories and tons of clickbait, which is putting people off. Oh, and native advertising too.
And the whole business model of Vox and BuzzFeed and Verge, all these guys the huge part of that is corporate media, and Vox and BuzzFeed have both raised serious amounts of money and are doing serious traffic. What are your thoughts about those two, or that trend?
Yeah, well, there's not too many that can play in that box. I mean, Vox and BuzzFeed and so on. It's not a business model that's available to many other people. And what we really need is a thriving media industry. We have to have a competitive media industry. We need many media sources. San Francisco used to have a dozen daily newspapers. Now it can barely support one and a half, say. So unless these companies are able to thrive, and also not thrive on billionaire handouts like Warren Hellman giving $5 million here, and so on and so on, it has to be supporting, and it has to make money. And there's nothing wrong with making money out of media, despite all the moves towards non-profit status for media companies, for example. Well, they're not making a profit anyway. And we need to develop a business model that works no matter where you are, and that can support a thriving and competitive industry. And we're nowhere near having that.
I've thought a lot about this corporate media. The other side of that coin, terminology-wise, is content marketing, right? When a corporation or an enterprise is looking at building media content, they're thinking about it as content marketing, and it's incredibly effective, actually. But it is limited. Content marketing is not going to support the war in Syria.
Well, content marketing, that comes out of every company is a media company, which I coined that term almost a decade ago, because I saw that as the media industry shrinks, companies are going to have to take on more of the role of telling their own story, right? Which is fine. But so now every company is a media company is well understood, and the whole content marketing boom is based on that. However, they're missing a fundamental point, which I've only just recently been reminding them about it, is that media companies don't write about themselves all day long, or just video about themselves all day long. They provide a service. Financial Times provides a financial news service. Yeah. So every company's a media company, fine, but you've got to find a media service you can provide your community, your industry, or whoever you're trying to reach. And if that content is self-serving, well, that's really marketing. It's not, and the problem with content marketing is that a lot of it looks like marketing, and it shouldn't. And also another problem that companies face in producing this content, media content, is that it's hard.
It's very hard. Producing good content is very hard, and I think most of the companies out there that claim to do content marketing do a very poor job of it. And then some of it is limited by what they have to produce content on. If you're selling a toothbrush brand, how much good content can you produce on a toothbrush?
Right. Yeah.
Right?
Exactly. I was on a panel last year with one of the comms directors from, I think it was Hyundai, the Korean car manufacturer. And he said, yeah, we're pushed to have a 24/7 newsroom, but even I'm bored with all the stuff about us all day long. Well, exactly. You need to find a service that you can provide your community, because then also you don't have to write about toothbrushes all day long yourself. You provide a service. And also, if you're able to provide a media service that is popular, that becomes popular and so on, it's very difficult to force you out of it. A competitor can't really just come along and force you out of it. It's like, some people complain to me about TechCrunch. Well, they still go and read TechCrunch because you have to, because it's the largest publication in the tech sector. And that's the same thing with every company as a media company. If you can establish yourself in that pole position, it's incredibly valuable, But companies don't know how to be media companies. And it's unsustainable and unreasonable to expect them to become really good media companies.
So, Tom, you have a question from the audience. Folks, when you ask questions, please set your chat to send to all participants. Do not send private messages to me. This is, it's the public roundtable. So the question, however, it came to me privately, Tom, I'll read it out, is can Tom briefly explain native advertising?
Sure, yeah. So native advertising is an article that looks as if it was written by the journalists of that publication. The format and the presentation is usually made slightly differently. I think the New York Times uses a different font. But for example, the New York Times native advertising is prepared by the advertising group of the company. The journalists have nothing to do with it. So that sets up an interesting schism there, for example. They're allowing content that looks like it's written by their newsroom, but it's not controlled by their newsroom. And although it says paid for by Dell, for example, the whole premise of it is to disguise it as if it were a piece of independent journalism, which is outrageous in just that regard, and yet, and also the brand, for example, Dell, is subsuming its own brand to try and look as if it's coming from the New York Times. And I don't understand how the brand wants to subsume its own brand on another brand, or that the media brand wants another brand to kind of hijack its own trusted reputation in that way. It just doesn't make any sense to me. And I'm surprised that there hasn't been a larger outcry over this practice. Yeah,
it's disingenuous, and it kind of erodes the main, asset that a media company like a New York Times, for example, has built over such a long time, is trust. And once you lose that trust, it's not easy to rebuild that trust. Yeah,
New York Times is one of the few trusted media organizations out there. Yes, they occasionally mess up, but they have very high standards and produce great work. If we start losing those types of trusted media organizations, then we're going to be in trouble, or bigger trouble than we are now. Yes.
All right. Well, that actually, audience, if you want to start asking questions in public chat, you can at this point. We will pick up and start answering questions as well. But meanwhile, I also want to invite our first presenter. Tom, you're staying a bit, yes?
Sure. Oh, could I just say one thing?
Yeah.
Thank you for the opportunity. I just want to leave you with this idea of media as a service, which is mass media is the best media. So if you use the acronym.
Okay. Interesting thought. Once we do a few more presentations, Tom, if you like, you can elaborate on that. And if you think there are entrepreneurial opportunities in there, we could see in the audience what the reaction is.
Sure. Okay.
All right. So Debashish Sinha is the first presenter. ZenNut is the company. Debashish, please unmute your line and tell us what you're working on.
Shamana, thank you so much. Can you hear me?
Yes, we can hear you fine.
Lovely. Thanks so much for the opportunity. And so as Tom was talking, it occurred to me that it's really interesting how over the last 10 odd years, every industry seems to be going through pretty much the same sorts of conversations that you and Tom just had around how an industry gets disrupted by the internet and the mobile application areas as well. Anyway, thank you so much for allowing me this opportunity to talk to you and to all of the attendees about ZenNut. My name is Debashish Sinha. I'm the founder and chief executive officer for the company. If I take you to slide 2, and Shraman, I believe you're handling the slide. Lovely. So we have about 5 or 7 minutes for me to explain what we do, and I'd like to use the next 5-7 minutes to get your sort of high-level feedback on what we might we should be focusing on as we move forward. The basic problem that we launched ZenNut to try and solve has obviously existed for a really long time, and you know, as is true with most entrepreneurs, we built this company based on some personal experiences. About 5 or 6 years ago, I was typical senior executive in the corporate environment, overstressed, overworked, a lack of sleep, overweight, et cetera. And about 5 or 6 years ago, I decided to go through sort of a personal transformation in terms of both my physical, mental, and spiritual health, if you will. And having gone through the process, I realized that there are a lot of people out there who, especially in corporate environments, who have similar challenges. And with that comes rising healthcare costs, loss of productivity, loss of teamwork, stressful work environment, lack of motivation, et cetera, right? So all of the basic challenges. And what we found was that the capability and the availability of tools, technologies, and processes to support healthier living within work environments is quite fragmented. And so we decided that what we would focus on within sort of this health and wellness at an enterprise level is to build a solid workflow engine that can help enterprises very quickly and easily launch, track, manage, and report on the health and wellness activities of their employees, and so to an extent motivate people to take on more and do more about their health. So if you go to the next slide, sort of the vision, in order to set one, is really very simple. By 2020, over the next 5 years, we want to focus on having 1 million healthier people that were influenced by the work that we do. The team, we founded ZenNut now about 6 months ago. We first came together. My co-founder and I, my co-founder Navdeep and I have been sort of friends for the last 30 years. We met in engineering school. He spent the last 25 years of his life deeply involved in sort of leadership in the engineering, sort of product engineering space with Microsoft and Amazon, companies like that. And I spent the last 26 years mostly around technology, consulting, services, marketing, sales, in that area. So we decided to come together, me primarily taking the responsibility for sort of outside leadership, if you will, on the sales, marketing, and business strategy side, and he leads all of engineering. Very, very strong capabilities around both engineering and understanding of business process. Just to give you a quick snapshot of where we are today, over the last 5 months, we formed the company. We committed about $100,000 of our own money into seed. We've used about half of that. The other half is available for us to continue to build the company while we now look at our first round of external funding. Our plan was to build a prototype. So we started in March. Our plan was to build a prototype by May, launch it to our first, sort of going through a fast fail process, launch it to our first customer, see how it works, get feedback from that, and then our beta product actually launched into production last night, and our first official beta customer is going to be in production this morning, pretty much right after this call. We had about, and I'll go through a little bit of the learning and experience from our prototype. The startup team was a team of about 7. We now have about 8 people in the company, including the founder, primarily focused on the product management, UX, UI, and engineering and backend. The technology is all built on AWS and sort of Java backend and AngularJS frontend. Bottom line is that it's exceptionally scalable as an application and can be deployed globally within minutes, which is what we kind of proved in our prototype as well. One of the sort of fundamental differences between a lot of the wellness program type of the things that are available, and there are thousands of them in the market, is really around the fact that what we are putting together is a workflow engine. It has the ability to integrate with every other sort of program or tracking application or device that's available in the market, right? So we're not actually competing with 90% of the money that's kind of spent in the wellness industry, but actually collaborating with them. So let's just go quickly to the next slide and talk a little bit about our prototype. So we launched the prototype with our first client. The expectation was that this was a Bay Area company with Darth Vader is back.
Maureen, can you just a second, Devashish. Maureen, it seems like Tushar is generating all this noise. Can you mute his line, please? All right, go ahead.
So the initial prototype was, as per plan, launched at the end of May, and we had expected to have about 20 people from one office join the first event that we created, which was sort of a run walk challenge for the month of June. As it turned out, people from all across the world, and in the U.S. that was Sunnyvale, Boston, England, Switzerland, Germany, and then people from Singapore and India joined as well. And so we ultimately, it ended up launching a prototype within 2 months of starting the company that had 220 odd registered users, across the world who were participating in this. So gave us a
But this is in one company? These 200 plus global users are in one company?
In one company, across all of their.
And is this a paying client for you? Is the company paying?
No. This was a prototype that we launched, right? So it was literally one small functionality, one small application. We did not, in fact, our general availability, we will go to general availability at the end of September. We have 6 weeks of beta trials that we're going to do through to the end of September, at which point we switch over to the paid subscription model. But it is a subscription model. At this point in time, all of our users that are using the application are essentially on a free trial. So what we find is that we're in a market that's currently about $40-odd billion in revenue, growing, expected to grow about 3 to 4% in the next 5 years, 3 to 4 times in the next 5 years, of which about a quarter of the market is specifically dedicated to managing the enterprise wellness workflow, right? So right now, a lot of this is fragmented. A lot of it is done by benefits administrators and HR sort of assistants trying to cobble together these events and manage the process by phone and email and Excel. With the application that we put together, we find that somebody can do in 5 minutes what used to take them a couple of days to put together. And that's been proved both by the prototype and the sort of pre-beta discussions and discovery that we've gone through so far. So it seems like a fairly interesting.
Hold on 1 second. You have direct competitors in this market, and I know because I've talked to several of them. We even have done stories of some of these direct competitors. So I think the real question is not the indirect competitors, but what's happening with the direct competitors, and what is the bottom-up TAM analysis? What you're doing here is a top-down TAM analysis, and it's kind of, in the business that we are in building startups and raising money for startups and all that, for those who are building funded businesses, and it seems like your goal and game plan is to raise money. Top-down TAM analysis is absolutely useless. You're going to need to do a bottom-up TAM analysis to show exactly what is the market opportunity that you're going after. Your market opportunity, I can guarantee you, is not $32 billion.
Correct. That is absolutely correct. So there is a bottom-up approach associated with looking at the sizes of companies and what they're doing, and how many subscribers and how you get paid for it, and what others in in this space sort of direct competitors are doing, and that's going to lead to what is sort of the actual addressable market, if you will. Obviously, we didn't have time to go through that entire analysis with you today, but I absolutely take your point, and that is definitely something that needs to be done. We've done the homework, and there's Excel spreadsheets of sort of a bottom-up analysis as well. But at the end of the day, as well as most people, that any of the numbers that I can cobble together or put together is useless, because it's only when I actually launch the beta, go to market, and start selling will I get a good sense of what competition, what my actual value proposition is relative to competition, and what sort of the market opportunity. The market opportunity is fairly large.
So none of those statements are true, by the way. That statement that you made is absolutely not true. Those numbers matter. They matter hugely, especially if you're going to investors. The competitive analysis matters hugely when you go to investors. It should matter for you in making your decisions. It should make a lot of difference for you in learning from what those competitors are doing. What is the table stake feature sets that they're offering that you're going to have to compete against? All these things matter hugely.
Right. Cool. No, good point. In terms of the go-to-market model, just very briefly, the idea is we're selling to enterprises. So a lot of our experience with enterprise sales will come into how we do the direct marketing and sales. But I think very importantly, what we've been focused on over the last couple of months is identifying what our opportunity is for direct sales. And to that extent, we've identified some fairly good initial partners, both around the insurance business, some very large insurance companies, as well as large insurance brokers, and as well as technology portals that primarily focus on employee engagement, with employee wellness and corporate wellness being sort of associated with that. So a lot of our early market development has been in looking at indirect channels and how to use that as a way to gain a fairly large subscriber base, while we kind of look at the direct marketing and direct sales models as well.
Right now, at this stage of the game, you will get no response from the channel. First and foremost, get out there, get a bunch of customers, show value, show ROI, show adoption, and then channel partners are going to be interested.
Okay. Great. Okay, so there's about at this point in time, we wanted to have about 2 channel partners and 4 or 5 companies who were doing our beta with us.
There's no channel partner working with you at this stage of the game.
Well, okay. We actually do have 2 channel partners who are working with us. One of them we're sort of co-launching and the beta with, and the idea is that we go through a beta with them for the next month, and then we take the product at the end of September out to all of their clients. So that's actually signed. So we were lucky in finding at least one partner to work with us. I'm hoping that I'll be able to convince a few more to do this as we go along. But
maybe I'd be surprised if you can get the sales, the people who are actually going to be doing the selling and to the customers to adopt the solution that early. Anyway, good luck.
I understand.
Make it happen, fantastic.
Yeah, cool. Thank you. So questions I had for you really were around some of the things that you just talked about. Like, what do you see as the execution challenges in this business? Who do you see as our primary competitors, and if there's anything that you can tell me about, what they see as their challenges, or you've seen as their challenges, would be obviously very helpful. What are some of the key
You should go dig. There are at least a couple of case studies, maybe 2 or 3 case studies that I can remember that we've done, and I don't remember all the names off the top of my head, but just very quickly, one is Virgin Health has a employee health management solution that is quite interesting, and we have a case study on that on our blog.
Okay.
There's another company up in Seattle, and I am blanking out on their name, but look in the.
Right.
Do you know which one I'm talking about?
Yeah, there's one company up in Seattle called Limeade. I don't know if
Limeade, yes, exactly, Limeade.
Right.
Limeade is actually quite is scaling nicely at this point. It took them a long time to get their bearings, but it's scaling nicely at this point.
Right.
So there's
a case study
of that one as well. So you can look at those, and you know, the case studies are very detailed, and this is why we have these case studies. So folks, all of you, if you are working on a particular sector or working on things that you're trying to understand subjects, you're trying to understand trends and so forth, we have a tremendous amount of content online. Actually, you know, while you could say that what we do in terms of content is content marketing, this is we are running a real media company. Tom, what is your take on the kind of content we do?
I think it's very good. I think, you know, it deserves a larger audience, really. But I know, you know, I mean, you guys are a media company too. I mean, you publish a lot of stuff, you do interviews and so on. But again, it's getting to that platform. It's building up an audience and getting in front of people. And that's why I think always, like you guys, you're concentrating on quality content. And that's what I try and do. You know, we shouldn't be wasting people's time with stuff that's not of quality, that's not
with rubbish.
The original. Yeah.
So folks, those of you who are trying to learn, you know, within our core area, which is technology and technology-enabled services, in your competitive analysis, in your, you know, desire to learn about an industry or what's happening in an industry, there is a tremendous amount of quality content on our site. Debashish, definitely take a look at these two case studies, and you will find insights from the horse's mouth, because these are the CEOs of those companies relating, or the, you know, head of those product lines that are relating these stories, and you will learn. And I ask them always very pointed questions so that, you know, the audience can learn.
Yeah, you ask tough questions. So
I ask very tough questions. I don't let them off easy at all.
Right.
So, Debashish, your other question about funding. Sorry? Tom?
I just want to say that entrepreneurs are an interesting breed, because it's very difficult to convince them of anything otherwise, because they live and, you know, 20 and it's a unique viewpoint that is difficult to influence often.
Yes, and you know, that's kind of part of what we have done here in these sessions, is really give out very, you know, kind of undiluted direct feedback and stuff that they need to hear as opposed to stuff that they want to hear. So Debashish, you're getting some of that kind of feedback from me as well, and the intent is that this is a working session. I don't want to tell you what you want to hear. That doesn't make this a working session. That makes it a mutual admiration society, which I have no interest in running. So, Debashish, let me answer your last question about raising funding. If I were you, I would try to get this client that you're working with in the beta customer mode, try to get them to pay. Having paying customers is a level of validation that gives you much, much higher credibility with investors than anything else out there. This is a segment that is actually validated. The problem you're trying to solve is validated. So when an investor looks at your business, they're going to look at a couple of things: your capability for execution and your ability to get to paying customers at this point. And then the second thing is that what the competitors are doing and how the market is tracking and what's working, what's not working, what can you learn from the competition, because many of these, you're just starting this company, whereas Limeade and what Virgin is doing, these guys have been around for a long time.
Right.
There's another company in Rhode Island, by the way, that is working on a very similar thing, and the name blanks out for me right now.
Right.
But it's a good company.
I don't know.
So these are good companies that have already been around for several years and have generated experience. So I think if I were wanting to invest in this business, I would want to understand in a lot of depth what those companies are doing.
Right.
Okay.
Let me, if I can, just take one more minute and ask you a follow-up about sort of this investor mindset. Because this is a very well understood industry, excuse me, sorry, and reasonably well validated problem statement. There are companies that have been working on trying to solve the same problem for the last 7-10 years, and using the technology and various ways to do it. You're absolutely right, and so to show revenue and to show that you understand competitors and what they're doing and what other people have done is very important. In that vein, though, do you see VCs, I mean, especially when we're talking about like a small round of $2 million or so, do they need to see disruption of a space? Because one of the interesting things about the business that we're building is that it's a better mousetrap in a certain sense. It's not a complete disruption of an old industry like Uber or anything. So do you see a lot of these external investors wanting to only invest in the unicorns that are going to disrupt an entire industry, or are they also interested in businesses?
Depends on which investors you go to. If you take this opportunity to Andreessen Horowitz, I don't think they would be interested because they are looking for those Uber kind of disruptive things.
Right.
Now, if you took this business to Andreessen Horowitz while it's generating already $10 million a year, they would be interested because then they're executing in scale as opposed to investing in early stage. So, so you'll have to find investors that are value investors as opposed to momentum investors, and VCs come in all shapes and forms. The truth is, if you can bootstrap it to $1 million in revenue, you'll have a lot more options in terms of investors at this point.
Okay.
So my take on this is, because you're coming in with a not as disruptive, not as differentiated, not as exciting business plan, you would be better off if you can you're getting the product out in September. If you can get, however many customers it takes for you to get them up to $1 million and get them to pay, if you can do this with revenue as opposed to, it's going to take you 6-9 months chasing investors. Instead, if you spend those 6-9 months chasing customers and get customers to pay and get this up to $1 million ARR, annual recurring revenue run rate, your chances of getting funded is going to be much higher.
Right. Cool. Sounds good. That makes a lot of sense. Thanks, Ramana.
All right. So I kind of want to switch gears and Tom, pursue your media as a service concept. So would you like to explain that in a bit more detail of what you are envisioning, and so that our entrepreneurs out there who are looking for ideas have some insights into what is the opportunity that you are identifying here?
Well, there's two sets of opportunities. There's one as a new type of media publisher, but also if you are a company, any company, what does it mean to become a media company? Well, you do need to learn some of the skills of being a media company, but it's all about, at the end of the day, producing media that's a service. I mean, a business, for any businesses, any successful business provides a service that people find valuable by definition. And so if we look at media as a service, it's a different form of corporate content, if you will. We have marketing communications, we have corporate communications, and we still need those things. We still need the content that says we're wonderful, so on. But there's also a third chunk which is what I'm calling editorial communications. And the editorial communication surfaces the authenticity of an organization, if you will. It surfaces the blog posts, their involvement in their communities online. And anywhere where that's happening, that content, there's a simple test to apply to that content. Is it of service to anybody, or is it self-serving? If it's self-serving, then that's the marketing bucket. But media as a service is a really virtuous media. Media as a service, the acronym mass media, it really is, I think, the way corporate media will develop in the future into something that is useful and important, and that can actually become aggregated to actually develop and
let me decode this from our entrepreneur's perspective. Let's say, folks, if you want to build a media as a service company, you want to have a really top-notch editorial team, journalism team, and then you offer to run the entire media, corporate media activities on behalf of various companies that are looking to do content marketing, looking to do media as a service. And that also means that this is not some little, shop somewhere that is producing, run-of-the-mill, stupid, rubbish blog posts, which is what there are tons and tons of. Go on Elance or Odesk, and you see tons of companies that offer this service of producing blog posts for you. Most of it is absolute crap. No one reads that. Yeah,
exactly. And in a way, there's an analogy here with the chip industry. About, say, 30 years ago, to produce a chip, well, you needed to design the chip, but you also then needed to build a factory to produce the chips. And as the chip fabs got more expensive, companies got together and they jointly funded a chip fab. But then TSMC, Taiwan Semiconductor Manufacturing Corporation, came along and invented the chip foundry business, where you literally faxed your design in. So 5 guys in a room, or 5 people in a room could design a chip. They didn't have to build the chip factory as well, which is in a sense what Tesla's doing. They have to build the factory to produce their car. It's a shame we don't have a chip foundry model for, say, the car industry. And the chip industry went through an amazing innovation cycle that's still here with us. It enables. This is why we have cheap iPhones and cheap electronics and so on, and it's continuing to get cheaper because of this innovation. So I think we're going to see the similar kind of process happening in corporate media.
I think that's a very astute observation, that it's a service that is needed, and it's something that when people try to do in-house or try to do it with these, kind of cheap shops, they do a very sordid job of. I happen to agree with you on this one.
You've got to do it again. You've done it. You did it today. You've got to do it tomorrow. You've got to feed the beast. Being a media company is not easy.
No, as we know from experience. Okay, well, I'm going to take a few minutes to explain to our audience how we work in 1 million by 1 million, and then we are going to do open Q&A. So folks, line up your questions. You can start putting your questions in public chat. Get ready to call in if you choose to call in. I'll just take 5 minutes to explain to you how to work with 1M1M if you want to. And before I do that, a request to those of you who are swimming in entrepreneurial waters in the ecosystem. Please recommend 1M1M to serious entrepreneurs if you like what we do. We are kind of we give feedback that's not easy to take often. It is direct feedback. Sometimes it's negative feedback. And that's just, it's not negative gratuitously. It's negative because we want you to improve, and we want you to address what's not working in your business and what to do about it. So we try to be as constructive as possible. So there's a delta between this session, before this session and after this session, that you have got some value and some homework to work on so that you can actually make progress with your venture. That is the ethos of 1M1M. We do this here in the public sessions. We do the same thing in the private members-only sessions where we do a lot more in-depth coaching and so forth. So you will find everything at 1mby1m.com. We have a terrific blog which is free and which is public. There is a tremendous number of case studies where you will learn a lot, and you can find the ones that apply to you, that are relevant to your industry, your situation, and so forth, and go learn from those entrepreneurs. And then we have the Entrepreneur Journeys book series, of which we've published 12 volumes. Each of them double-click on a specific topic. You'll find all of them on Amazon Kindle. This could be, the latest of these books is $1 Billion Unicorns, which digs into, what can we learn from the people who have built $1 Billion Unicorns? What is repeatable? What is pure sheer luck? Luck is not a repeatable event, but in every entrepreneur's journey, there are things that you can learn, there are things that you can copy, and that's what we have tried to do in the Entrepreneur Journey series. So it's a very low-priced entry point into the 1M1M program and its methodology. We do case study-based learning. We try to simulate the experience of actually having you sit down with experienced entrepreneurs and learning from them. That's the philosophy of the program. There is a ton of videos and video FAQs and so forth on the blog. On the website, actually, you'll be able to find a lot of things. Dig around on the website to see if this program is for you. It is not for everybody. The program is for people who are self-learners. If you need to be spoon-fed in your learning experience, that is not who we are. And we don't have the capacity to do that, and you will not succeed in the program if that's your mode of learning. But if you are a self-learner, and frankly, entrepreneurs need to be self-starters, self-learners, they need to be self-motivated, so it kind of self-selects people who have the capacity for self-learning. That's the kind of entrepreneurs who do well in our program. These roundtables, these Thursday roundtables happen every week, and you're very welcome to book a slot and come and pitch and get feedback and brainstorm. Just go to the website and go to the free public roundtables page and register to either pitch or to attend. Then we have the 1M1M Premium program, which is, we offer extensive methodology guidance in the program. We have a curriculum that is rich, and again, it's case study-based learning, video lectures and case studies. And we help you with business development. We have an extensive Rolodex. We connect the dots with that Rolodex and our entrepreneurs. We help you with whatever you call it, strategy consulting, coaching, mentoring, whatever it is. It's these direct roundtables. We have a version of that behind the premium lounge. And then we help you with financing with the caveat that your business has to be fundable. Not all businesses are fundable. Over 99% of the companies who seek financing actually get rejected. However, that does not mean that your business cannot succeed. You can build a self-finance business up to 5 million, 10 million, 20 million, 50 million, and some of our case studies, some of our entrepreneurs have even built companies up to $300 million in revenue. There are 3 case studies in the $1 Billion Unicorns book where all 3 of them are running $300 million plus companies. They're aiming to get to $1 billion annual revenue run rate, not valuation, revenue. This is real. Valuation can be some, pie in the sky, some bullshit, but revenue is not. Revenue is real. And these are 3 companies that are unicorn companies if they wanted to go public or if they wanted to get valued in the private market for additional financing. They're doing none of that. They're basically building their companies, and these are phenomenal case studies. So you can be successful without financing. Don't get obsessed with financing. But if you want to get financing, if your business has the characteristics of financing, we'll help you get funded. And then we also help you with media relations, and also we help you get the word out with our own clout in the media. You'll find case studies of successes in the program on the $1 Million Club page on the website. You'll find an ROI equation of 1M1M itself, it's a very high value program that costs very, very little, like $1,000 annual membership fee. We have people in the program that stay for multiple years because they get value. And today, if you have to get that kind of value in the market, it's going to cost you 5 to 10% of equity and probably $375,000. So look at the analysis of the ROI on what are the vectors in which we offer you value. The 1M1M self-assessment is a very effective one to put your business through as you are evaluating where you are, what pieces of the puzzle do you have in place. So especially if you're thinking about going out for external financing, definitely look at the 1M1M self-assessment. It's publicly available on our blog, and ask yourself these questions and see if you can answer them. If you're a premium member, there are curriculum modules attached to every single question which will help you fill your knowledge gap. I know many first-time entrepreneurs do not really know how to do a lot of these things that you need to do to build a business, and we give you curriculum modules on all of that. The premium program, go to the website, learn what to expect from the premium program, learn from the FAQs, and see if this program is for you. If it is for you, we'll be very happy to have you in the program. If it is not for you, no problem. Learn from what's publicly available in terms of case studies and so forth. Learn from the public roundtables. Engage with the program at whatever level is comfortable for you and whatever level you can get something from it. We have probably a community of about 250,000 people at this point, and people are using the program at many, many different levels. They're engaging with the program in different modes, and we are fine with all of that. Really, our objective is to be helpful to you, sushi style or 5-course meal, whatever you want, but we just want to be helpful in your learning process. The curriculum is an interesting curriculum because we have had over 600 successful entrepreneurs participate in our case study program, giving you advice, giving you their lessons from the trenches, and we have stitched it all up into a efficient, easily consumable, portable, accessible from anywhere in the world curriculum. And it's effective. We've been using this curriculum to teach our entrepreneurs for 5 years now, and 5 years is a long, long time, to use a program, improve a program, fine-tune a program, tweak, figure out the kinks. It's a pretty robust curriculum at this point. Our methodology is lean, capital-efficient, bootstrap startups. Even if you raise money, the philosophy is bootstrap first, raise money later, just because that's what works. That is how the industry works. That's what works in being successful. So there's a question from the audience. Narayana is asking what is meant by bootstrap. So bootstrap is building a business without outside capital. If you look around, the media is doing a tremendous disservice to entrepreneurs out there, first-time entrepreneurs, young entrepreneurs, by representing entrepreneurship as financing. Our philosophy is entrepreneurship equals customers, revenues, and profits. Financing is optional. Exit is optional. Exit is compulsory if you take external financing that expects an exit. So if you take venture capital, for instance, they will expect an exit. But venture capital is not entrepreneurship. You can be a successful entrepreneur without venture capital. In fact, venture capital caters to a very small number of entrepreneurs. A very small sliver of the entrepreneurial universe fits the venture capital model of this hyper-fast growth, hyper-large business opportunity model. So you will, and even to get to venture capital, these days VCs kind of like to come to the rescue of victory. So you will have to create a lot of traction around your business for the VCs to be interested. So that means that you're going to have to do a bootstrap phase successfully before you will be able to attract capital. So that's pretty much, my overview of the program. Feel free to ask questions. And if you are trying to build an entrepreneurial community anywhere in the world, you're welcome to partner with us. We actually partner with a lot of people. We partner with corporations, we partner with governments, we partner with local organizations who are trying to do local community development, and we are very happy to work with you in developing your community as well. Upcoming free roundtables, pretty much one more in August and then every week in September. So lots of slots available. Vision India 2020 is the 13th book from the 1M group. I have published 45 of my own billion-dollar business ideas in this book, and it's an ideation book. So it's kind of set in the backdrop of India, which is where I grew up, and it's written as business fiction. So it's kind of like a futuristic retrospective. We are sitting in 2020 looking back on building all these businesses. So it's got a lot of details on strategy and execution and nuances and so forth. So you can take any of these ideas, you can build on them, you can morph them, you can steal from them, borrow from them, whatever you want to do. It is designed to make, ideas stir in your brain. And it applies, by the way, even though it's written in the context of India, it applies to all the emerging markets, whether it's Southeast Asia, Latin America, Africa, all kinds of different markets would be amenable to some of these ideas. So look around, and if you're still in the stage of development of your venture where you haven't fully figured out which idea you're going to execute on, what is going to be your path forward, this is a good book to get you to stir ideas. The 1M Incubator in a Box is our program that we primarily use with corporations today. We have a lot of corporate partners that we do this Incubator in a Box program where we essentially run their incubators. And now we're starting to do that there's an announcement that will come shortly with one of the state governments in the United States where we have a similar program starting up. So again, if you represent an entity like that and if you're interested in working with us in this mode, we'll be happy to partner with you. So very quickly, these are the latest Entrepreneur Journeys books: Billion Dollar Unicorns, Carnival in the Crowd, Bootstrapping with a Paycheck, From E-Commerce to Web 3.0, and we are ready for further Q&A. You can use the public chat to ask questions, and you can use the call-in number to call in as well. Either way is fine. Let me see if I can pick up the questions from the public chat. Here's Narayana is asking, what is the role of luck in business success? I would say huge. Tom, would you like to take this question?
On luck? Yeah, I mean, I remember Dan Scheinman at Cisco once saying, it can either be too early, too late, or right on time. It's extremely challenging even when the time is right for your idea and market. And yeah, luck does play a part, but also it's difficult to tell, how much of a part it plays. Clearly, experience plays a huge part, and that's nothing to do with luck.
And I think the timing thing that you bring up, Tom, is very interesting and very difficult to get right. I'm actually generally ahead of the market. So being behind the market is as hard as being ahead of the market, because when you're ahead of the market and the market hasn't caught up with your ideas, it's really complicated to stay in business. I did an online fashion, personalized online fashion company back in 1999. It was way ahead of the market, and today online fashion is a huge thriving category, but this is 15 years later. 16 years later, and I was way ahead of the market. And whether you call it luck, you call it timing, it's hard to get right.
It is very hard, yeah.
Other questions, folks? Line is open. Public chat is open. We are happy to answer questions.
I like your, by the way, your book of 45 ideas, is it? Because, I'm coming up with business ideas all the time because, here in Silicon Valley, we can see a little bit further into the future than other people often. And, you know, there's a lot of great ideas to be developed and so on, but really, you have to ask yourself, if you pick one of these ideas, am I willing to put, you know, all my time into developing this business?
That's right.
And there's very few great ideas that, for example, personally, that I feel deserves so much of my time to develop. And you know, just coming up with an idea that might work is not enough. It really has to drive you and get you out of bed in the morning and keep you out and keep you passionate about the idea. And so you have to be very persistent with that idea. This fashion of pivot if things aren't working out. Well, yes, you should pivot your business, but often there's not enough persistence, stubborn persistence in a business idea. We seem to be lacking that these days.
I think you bring up a very good point. The beef I have against this lean startup movement, which is very popular these days, is exactly what you said, is that it's pivot, pivot, pivot. It's all instant gratification. There's no commitment to a big, broad vision, which, you know, maybe you have to work hard for it. Maybe you have to have staying power and persistence and not pivot to something that may work, may not work. But, I mean, there's not enough conviction. People are kind of somehow or the other trying to get something working, and I think there's a bit too much pivoting going on and not enough persistence.
Which is fine if you're a ballerina, right?
So Narayana, you're trying to synthesize what we said. You're saying, I think luck is about right people, right funds, right idea at the right time. Maybe, and then maybe sometimes it's right deals. You know, sometimes you're trying to build a business and a right deal clicks in gear. Like if you look at Microsoft's history, Microsoft got a deal with IBM very early in their history. And if that deal had not happened, Microsoft would not be Microsoft today.
Yeah, that's a good point. Yeah.
Right? So there is some amount of serendipity, some amount of, you know, some external things that happen that, you know, take you to the next level in a very big way. By the way, I'll recommend one book called The Black Swan. If you haven't read this book, folks, it's an interesting book that visits this idea of luck in a very, you know, profound way. That's something, if that's a topic that intrigues you, it's something that you can look up, yeah?
Yeah. And really, those black swan investments, the ones that come out that become huge, like Google and so on, well, they were ugly ducklings when they were younger. Nobody wanted to invest in them. So if you want to have that black swan investment, you should be investing in ugly ducklings. You know, I once proposed random acts of investment. You know, you'd be investing in qualified teams, but you know, these days we have 20 investments in the same types of companies, and the market isn't big enough for one of them, and so they eat each other up. Eventually, one comes out. But if we had random acts of investment, you have a better chance of finding that amazing black swan investment.
And a good case study, a case in point in what Tom is saying, folks, is Salesforce.com. You know, when Mark Benioff started Salesforce.com in about 98, 99 timeframe, there was a trend that was floating in Silicon Valley called ASP. And that was like application service provider, and they were talking about taking different applications and hosting them and offering them as a service. Of course, fast forward, that is now cloud computing, that is now software as a service, but all that was not in place yet. And Mark Benioff could not get funding. Nobody would fund Mark Benioff. Eventually, he got funding from Larry Ellison as an angel.
Yeah. But
all right, folks, I don't...
Another Salesforce, you know, is scale the most important thing, and so can a startup build up to become another Salesforce billion-dollar company or multi-billion-dollar company? I think that's part of the problem, is that it's really difficult to build that next big tech company in Silicon Valley.
Yes, very difficult. Building anything at scale, anything in a really serious manner is a very long-term commitment. This is not like some, get-rich-quick scheme. It's serious staying power, serious, block by block, heavy lifting for years and years and years. And I know it from my experience because I've done it many times.
Yeah, and you have to be comfortable selling. It seems often CEOs want somebody else to be selling. They want a sales manager to do that or whatever. No, the CEO has to be comfortable selling their service.
Absolutely.
And if they're not, then they should rethink what they're doing.
Absolutely. And a lot of technical people with technical backgrounds are not comfortable selling, and that can be the determining factor between success and failure. If you're not comfortable selling, then you're not going to be successful as an entrepreneur.
But
or at least you need a co-founder who can sell.
Yeah, but if you have something, a service, a product that makes somebody's life better, then that's not selling. That really is truly a service. You have an ethical obligation to bring it to them, to show them it.
The way I put it always is creating value. And Tom, I don't know if you remember, I think you read some of my writings when the financial crisis was happening, and I started pointing out the difference between value creators and speculators, right? We have created a capitalism that is hijacked by speculators, and we need to bring the focus back onto value creators. If you're creating something of value, something that adds, something that makes somebody's life better, then you are creating value. So selling is more making them aware of this value as opposed to forcing some shit down somebody's throat.
Yeah, and this is what the media industry is facing, is that everything's gone over to programmatic dashboards, where you're literally just figuring out, people who are awake at 11 o'clock at night and have these and these attributes and so on. There's no opportunity for a media publication to sell themselves to an advertiser, for example, and say, look, our readership is top notch, the quality of our content is wonderful. Once everything is in a programmatic dashboard, then that's problematic because there's no ability to really distinguish the value between these different media organizations.
Yeah. So, folks, while we are, wrapping up, I want to introduce you to Irina Patterson. If you have questions about the 1M1M program, Irina would be very happy to help you. She's extremely patient, and she has worked with numerous entrepreneurs over the time that we have been doing this, and she's very, very resourceful, very, very experienced, and please feel free to ask her questions. Devashish, thank you for participating. I'm glad you found it interesting. And Tom, thank you so much for weighing in on all these different issues and sharing your perspective. You were one of the most thoughtful people thinking about the future of journalism and media and Silicon Valley. So it was a pleasure having you today. Thank you for coming.
I enjoyed the conversation. Thank you.
Folks, thanks for attending, and we will be back here next week. If you would like to pitch or attend, please go ahead and use the registration page on the website to book your slot. Thanks for coming. Bye, everybody.